Joining us now, Doug Kass. Doug, I'm in therapy. There's no other way to put it. It's fun to watch the Yankees. Have you had more fun watching your dreaded New York Yankees in years?
The greatest, the most fun I think I've had probably in 10 years. You know, and you saw it developing. You saw a bunch of young players being developed, and even Jim Palmer in our interview on Surveillance a couple months ago was bullish on the Yankees and bearish on the Orioles.
Within this,
but last night was exciting, and I sent you an email. You noticed the standings as we have this interview. Winning percentage, .553 New York
Always
Yankees.
providing good notes to us here, Tom.
Why you keep your finger over the red button. That would be the exit cast button. Anyways, folks, for our global audience, this is exciting. And just one more comment on the baseball thing, Doug. I sat last year in the Doug Kass seats right by Joe Girardi to the left of the dugout. And there was this big lummox out on the on-deck circle. And you have seen this. Rookie baseball players need time to lose the panic of, OMG, I'm here. And that's what we saw with Aaron Judge from this year to last year, from last year to this year. And now you got this whole youth, this kiddie core coming up. I mean, it's amazing.
And Aaron Judge, 27 caters. And it's a remarkable performance.
You've been wrong, Doug. The bull market continues. When does this end? Last Friday, all the gloom. And you're not writing gloom crew emails. Describe the nuance of your caution on this bull market versus the usual doom and gloom stuff we all read.
Well, I think the issue to me is not how high the S&P is this morning. The issue to me is how long the markets will stay this high. And I think to understand what's happening today, we have to understand what's happened in history. And the fact is that very few active managers were able to deliver alpha over the last decade or so, and you saw it. They were not protected in the large drawdown in 2007-9, for example. And the public looks at these outcomes and says, why the heck should I pay higher fees to managers who can't outperform or can't identify speculative blow-off or an imminent drawdown of major magnitude? Let me just stay fully invested. I might as well be in an ETF or an index fund. So since 2007, the Great Recession, basically passive activities and indexing has risen from about 8% to almost 40%. And as you shift assets from active managers to passive managers, they buy an index. Since the index is capital weighted, it means more and more money is going into fewer and fewer stocks. And we've seen this before, and so have you guys. We saw it when I graduated business school in the early 70s with the Nifty 50 stocks. Yeah. You outperformed only if you continued to go into them. If you were a growth stock manager in the late 1990s, if you weren't buying the net stocks, you underperformed, you were fired. More and more money went into fewer and fewer stocks. The Nasdaq ultimately declined by 82%. So you have a similar case today with the FAANGs stocks. More and more money is being deployed into a narrow and narrow area. In each case, this trend doesn't end well.
Doug, let me ask you about the deal that we saw scuttled this morning between Walgreens and Rite Aid. What's your takeaway from what happened there? Does it shed any insight for you into the regulatory landscape? Does it say something just specifically about the sense of this deal in and of itself? What's your take on what we saw this morning?
Well, I would say not with regard to that deal, David, individually, but I do think that the political and regulatory landscape is moving unfriendly towards the market leaders, the FAANGs, owing to obviously a market dominance. And you look at, say, an Amazon, the question is to me, and I've written on the street about this over the last month since the Whole Foods deal was announced. The question to me, is Amazon a company that's providing lower product prices to the consumers, or is it creating jobs and the destroyer of our economy? And I think you're going to hear a lot about this going forward.
Within all this is use of cash, which is a fundamental concept, and I might point out to those younger that Mr. Kass has a little bit of experience in securities analysis. We're seeing it with a vengeance in the banks. Do you have the courage to short the banks here, Doug?
Actually, I just shorted this morning in pre-market trading Bank of America, Citibank, and J.P. Morgan.
Why?
On the ramp, and it's
Why?
simply a trade. Look, I think I followed the industry since I was a Nader-rater and wrote a book called Citibank with Ralph Nader, and while I was finishing my MBA at Wharton. This is an industry that has deleveraged and has a low return on assets and is barely earning its cost of capital. Its valuations have risen dramatically, and the industry faces three dominant headwinds: lower credit demands going forward, a flattening yield curve, and low absolute interest rates. And this could potentially be a toxic cocktail while the market is rejoicing this morning.
Well, while I have a toxic cocktail with Fortress Moynihan, good morning, Mr. Moynihan. I know you're listening. Operating income at BAC has gone 24, 26, 27, and somebody's modeling out for next year 32 billion large. I mean, as a growth vector, maybe it's not a diamond growth vector, but it's a Moynihan growth vector. How do you short that growth vector in operating income?
That's a little bit of data mining, because you have to go back and see what the disaster was the 5 years prior to that.
And you think we're going to revisit that disaster?
I don't think we're going to revisit it. I think the stocks are more than fully priced relative to their projected returns on equity.
Let me ask you, we were talking about regulation here just a moment ago. We're going to talk about stress tests a little later on the program. But what is what we've seen here over these last 2 weeks? These two rounds of stress tests tell you about the health of the financial sector here in the U.S.?
The financial sector is relatively strong, especially vis-a-vis the pre-Great Recession crisis in 07-09. But so is the industry's earnings power. It's much lower.
Yeah. Doug, fold in here what Chair Yellen's doing in central bank. You do that. It's not just all equity analysis for Mr. Kass. We've had a real shift in the last 2 days, and really for the first time since I can remember, it almost looks like a coordinated hope and prayer by bankers that inflation or disinflation will migrate into some form of greater inflation. Do you agree with the coordinated action of banks in their discourse and rhetoric, or does that end up being market volatility?
I think that they're going to coordinate in terms of tightening. And what I really don't understand is the market's ebullience. I understand the ebullience following a period of historically large monetary largesse. I don't understand. I don't envision a positive response in the fullness of time from tightening. It just doesn't follow. I thought you were getting at something, Yellen's quote on Tuesday.
Oh, yeah, no more financial crises.
Yeah. I mean, it's remarkable. I did a piece entitled "Some Really Stupid Things Uttered by Some Really Smart People on the Street" a day ago, and it's kind of a humble reminder, David and Tom, of how dim our visions are. We talk about the market's ebullience right now. The fact is, many sectors have gone down. Many shorts have been quite successful in 2017. And we live because of the dominance of passive investing and quant strategies in a market without memory from day to day.
Well, let's come back with memory and talk to Doug Kass of Seabreeze Partners. Lots to talk about. I think we should do a little more maybe investing 101, which is, in a log normal world, how not to lose money, which would maybe be of sport. With us on Investment Wisdom on how not to lose money, Douglas Kass, Seabreeze Partners. Doug, there's a guy named Van Tharp who wrote a really important book, and in it a jewel of a chapter years ago on what he called position sizing. I call it in my lectures the how muchedness, which is something nobody ever talks about, which is you decide to do this long, this short, and the real art is how much do you put into the trade. If you've been short and you've been in a long bull market, how do you not get wiped out? How does Doug Kass do the how muchedness when you commit to a trade?
Great question. One of the things, first of all, position size is a function of your time frames and also of your risk appetite or risk profile. I personally am a very conservative short seller. So I take relatively small positions, particularly against my core investment long positions. As well, I do a lot of synthetic puts. I short stocks and buy out-of-the-money calls. So what does that do for me? That basically allows me to quantify the risk I have not only in each individual short, but in my entire portfolio. Essentially, I'm paying for the privilege of protecting the short position. And that worked out, obviously, very well for me in 87 and 2007 to 2009. And I suspect when the markets finally do break, as they always have historically, it will work out going forward.
Doug, how much is the price of oil right now shaping your investment outlook?
Well, something that no one really is talking about. I'm of the view that not only stocks are overpriced, but so are bonds. And I believe that the 10-year is based upon my calculus, is projecting a sub 1% real growth in the domestic product domestically, and that's too low. And the recent decline in the price of oil, going, as Dennis Gartman, our friend, says, from the top of the left chart to the bottom right, is historically, at least that's what I learned at business school and used to work in the 70s and 80s and 90s until quant trading strategies took over. That's a stimulant to growth.
When you you mentioned Whole Foods a little while back, I want to ask you about that deal in particular, what it says about the direction of retail. When that news broke, Tom and I were scrambling just to figure out sort of what directionally that means.
When Doug has breakfast at Mar-a-Lago,
I forgot about that.
The avocado omelet, he wants a gluten-free Whole Foods avocado omelet.
Yeah,
that's the way it is.
Yeah.
I actually had dinner when the president of China was there.
You were there.
Yeah.
Did you conduct foreign policy with everyone else?
I was there for the briefing.
I was with a high-level I do have Republican friends.
Jesus.
I was with a high-level Republican.
Surveillance break exclusive right there. But, Doug, what does that say to you about the direction?
Kramer doesn't know that.
No. Direction of retail. What does the Whole Foods Amazon deal say to you?
Well, the disruption continues.
Yeah.
But, I would question and suggest we are approaching peak Amazon and peak FAANG for the reasons I mentioned, as well as the growing political and regulatory risks that these companies face. Look at the advertising market for a second. Facebook and Google have approximately 80% of online ad dollars going to them. Mm-hmm. Online advertising accounts for roughly 25% of total advertising today. So multiply 0.8 times 25%.
Very good.
And that means they have those two companies have 20% of total advertising in this country. And that's probably in the process of peaking. No one's talking about that much.
Doug, one final question, if we could. When do you cover a short? If we get to down 22,000, do you change your view? I mean, how do you flip to being a bull?
Well, I'm not flipping to being a bull. I am concerned increasingly about sector risks. I'm concerned about a higher percentage, as I mentioned, of assets in index funds. And I'm worried that both quant strategies and passive investing, which has been a stabilizing influence and a tailwind for the equity markets, will become destabilizing influences because fear ultimately will enter the marketplace. We probably don't know what the specific catalyst. And all you have to do is ask two words at that point. To whom are index funds and ETFs going to sell to? They don't carry any cash reserves. And active managers who have diminished in size, most of them aren't carrying high levels of liquidity for fear of business.
The last marginal...
So I think we're witnessing the development of potentially a perfect storm.
Okay, a perfect storm, yes, that defines the New York Yankees. Doug Kass, thank you so much. This is Bloomberg.